We will now look at free cash flow to equity models, models which value the equity of the firm only. With free cash flow to equity models, we're not interested in valuing the whole pie. We're only interested in valuing the residual portion of the pie that belongs to equity providers, the firm's shareholders. So we need a measure of free cash flow that is free for shareholders only. In other words, we need an estimate of free cash flow after the debt holders have taken their fixed share of the pie. Let's consider how we might arrive at this figure. Think about the income statement. What part of the income statement reflects the profit that has been generated by the firm that only the equity providers or shareholders are entitled to? It is the bottom line of the income statement, net income after tax, or the residual profit that is left behind after the debt holders and the taxman have taken their share of profit. Net income after tax is a good starting point for our estimate of free cash flow to equity. Remember, we still have to subtract off the additional investments required to maintain and increase the growth rate. But we can't simply subtract off the totals of the additional investments in non-current assets and working capital. And the reason why is the shareholders have not paid for all of those additional investments. If a firm is leveraged, for every €1 invested in a non-current asset, say a factory, the shareholders would have paid for a proportion of that euro, and the debt providers would have paid for the remaining proportion of the euro. And so, if we were to subtract off the totals of additional investments in non-current assets and working capital, we would be underestimating free cash flow to equity. We should only subtract off the portion of those additional investments that were paid for by the shareholders. And we can get that portion by multiplying the additional investments by 1 less the debt ratio. The debt ratio represents the proportion of debt in the firm's capital structure. So 1 less the debt ratio will give us the proportion of each euro of investment that was paid for by the shareholders. So to arrive at our estimates of free cash flow to equity, we take net income after tax and we subtract off the portion of the additional investments in non-current assets and working capital that were paid for by the shareholders. To get more comfortable with the definitions that we've used for free cash flow to the firm and free cash flow to equity, let's reconcile the two measures. Remember, we've defined free cash flow to the firm as NOPAT less the additional investment in non-current assets less the additional investment in working capital. Let's see if we can work backwards from free cash flow to the firm to free cash flow to equity. We'll use free cash flow to the firm as a starting point. Included within free cash flow to the firm is NOPAT. Remember, NOPAT reflects the earnings that are available to be distributed to all capital providers. Included within NOPAT is a fixed claim against the profits of the firm that belongs to debt holders. We need to exclude this debt claim to leave behind only the residual portion of earnings that belongs to the equity providers or shareholders. So we subtract off after-tax interest expense. The debt holder's claim or share of the earnings is reflected in the interest expense account. However, debt has a major financial advantage over equity. The interest payments to debt providers can be deducted in the corporation tax computation, and this will lower a company's tax bill. This is not the case with dividend payments to shareholders, which are not tax deductible. This feature makes debt a cheaper source of finance relative to equity. The financial benefit of this tax saving otherwise known as the tax shield, needs to be netted off against interest expense to reflect the true cost of debt to the shareholders. The tax saving, or tax shield, can be calculated simply by multiplying interest expense, that is, the amount of the deduction in the tax computation, by the tax rate. So if we take NOPAT and subtract off after-tax interest expense, we are left with the residual earnings that belong only to the shareholders. In addition, remember, this free cash flow to the firm measure includes the total additional investments in non-current assets and working capital. These investments have been deducted off when arriving at the free cash flow to the firm measure, but a portion of these additional investments were paid for with debt. And if we don't remove this portion from free cash flow to the firm, then we will be underestimating free cash flow to equity. We only want the portion of these additional investments that were paid for by shareholders when arriving at our estimates of free cash flow to equity. And so we add back the increase in debt during the year. This will remove the portion of the additional investments that were paid for by debt providers. In other words, what will be left behind will be the portion of the additional investments that were paid for with equity only. Once we've calculated our estimates of free cash flow to equity, we can insert the estimates as the numerators in our model. We then discount the free cash flow to equity estimates over the forecast horizon that we've chosen. At the end of our forecast horizon, once a company reaches a steady state and the growth rate has stabilized, we can use a perpetuity to calculate the continuing value, otherwise known as the terminal value. This reflects the value of all free cash flows to equity from the end of the forecast horizon to infinity. Finally, we add up the discounted free cash flows to equity over the forecast period and the discounted continuing value to arrive at a value for the firm's equity. What is an appropriate discount rate for free cash flow to equity model? If the numerator in the model is free cash flow to equity, or the free cash available just for the shareholders, then what is an appropriate denominator? What is an appropriate discount rate for free cash flows to equity? The answer is the expected rate of return by shareholders, which is the cost of equity. What drives free cash flow to equity? It is return on equity. Remember, return on equity equals net income, or that bottom line on the income statement, divided by the total equity capital that has been provided to the firm. Once again, you effectively embed an assumed return on equity into your forecast financial statements through the forecast ratios that you use.